Good afternoon, everyone. Ken Shreve with you, filling in for Tom O'Brien, hour number one of the Tom O'Brien Show today. My colleague Steve Rhodes will be handling hour number two from 5 to 6, but always my pleasure filling in for Tom. He's taken a few days off after going on the road with Steve for that Go Long America tour. Where was he? I think he was in Tampa, Boston, a few cities. So Tom taking a few days off, but my pleasure to be here with you. If you haven't had a chance to listen to my own show, Breakout Investing, please do so every Tuesday and Thursday on TFNN from 3 to 4 p.m. Eastern. And number to use if you want to talk to me today is 877-927-6648. Don't forget, folks, you can listen to all TFNN programming on your smartphone. Just type in TFNN.mobi. That's it, TFNN.mobi in your smartphone browser, and you can listen to the stream that way as well. And don't forget about Tiger TV, a great resource on the homepage of TFNN.com. You can listen and watch the show live on Channel 1. I'm going to be going over a few charts when I talk about individual stocks or the price action in the major indices, and you can look at those charts right along with me in Tiger TV. And Tiger TV is also viewable on your smartphone now. So, hey, let's use the C word again. Another constructive session for stocks. Right now, it looks like volume is going to be a little bit higher than yesterday. Yesterday on the New York Stock Exchange, we had 900 million shares. That was slightly above average. Pretty solid day for the market yesterday. I was listening to some commentary afterwards, and people not all that keen on it, but volume on the New York Stock Exchange yesterday was 900 million shares, above average. Volume really started to pick up late in the day after the Fed statement came out at 2:15 Eastern. What looked like another low volume session actually turned into a pretty decent session volume-wise, especially on the New York Stock Exchange. Again, 900 million shares traded hands yesterday. Looks like we'll be slightly above that today. On the Nasdaq yesterday, volume slightly below average at 1.65 billion, very close to that level today, but the final volume figures have not shaken out yet. I want to start today by talking about the Nysc Composite Index. I'm going to refresh the chart here, and then I will grab it again so it shows in Tiger TV. But the Nysc Composite Index, as I mentioned on my show yesterday, this is a broad-based index. It's not widely followed, but it does give a good indication of what's going on breadth-wise underneath the surface. And this index underperformed by quite a bit today. Actually, it was down 49 points, 0.6% to 8163. Last week, it bounced off its 50-day moving average, and but the thing to remember here is the Nysc Composite. If the volume holds right now, because it looks like Nysc volume is going to come in a little bit higher than what we saw on Tuesday, this would be another distribution day for the Nysc Composite. So that story hasn't played out yet. We'll have to see what the final volume figures look like. But this would be distribution day number 7 for the Nysc index. We touched on this yesterday. It is potentially problematic. I mean, my general take on the market here is that while I'm seeing very little in the way of sell signals in a lot of stocks in my Ultimate Growth Stocks model portfolio, have a lot of stocks acting well. I'm in no hurry to sell them because they're just technically still acting fairly strong. So you've got pretty good action in market-leading growth stocks, but you've got subtle signs of distribution in the major averages. Most pronounced at this point in the New York Stock Exchange Composite, not so much so on the S&P 500 and Nasdaq. Headed into today, we had 4 higher volume declines on the S&P 500 and only 3 for the Nasdaq. Let's move over and take a look at the S&P 500. You'll see that selling in this index today was fairly muted. It was only down 0.1%, just under 2 points to 1389, almost 1390, but closed virtually unchanged from yesterday, where it rose sharply. So even if volume does come in higher on the New York Stock Exchange, it's going to be hard to call this a distribution day for the S&P 500 because it hardly gave up any ground at all from yesterday. Moving on and take a look at the Nasdaq here, the Nasdaq Composite selling also muted in there. It closed just a fraction higher, close to 1 point to 3,040, pretty much right where it closed on Tuesday. So when it comes to for the Dow, S&P 500, and Nasdaq, pretty tame selling today. A little more selling in the New York Stock Exchange Composite. At this point, my general thesis is that, I think the best thing that could happen for this market right now would be a pullback. Only because there are a lot of extended stocks out there. I mean, let's check in on Apple today, talk about an extended stock. Apple has gapped up for 2 straight days now. It's already some 30% past its last entry point around 426. I mean, its last swing point was all the way back in this area, and then it gapped up when it reported strong earnings, and it's just run higher ever since. So Apple's very extended for new investors that are close to getting involved in the euphoria here and all the positive things that are being said about this company. I'd be very careful buying up here. You'd be chasing, and when you're chasing performance, that sometimes is an easy way to lose money. That said, there's a lot of positive analyst commentary about Apple. There's no question about it. I think it was Morgan Stanley, came out with a note earlier today, basically looking for shares of Apple to hit $960 a share in 2013 due to growing sales of iPad tablets in the corporate market, as well as an expected refresh of the iPhone 5 that will most likely run on the 4G LTE network. So a lot of raised price targets recently for Apple. And listen, I mean, it's really hard to knock this company in terms of fundamentals, in terms of growth prospects. It is doing nothing wrong. Technically, looking at the stock's recent price action, yes, there's been a lot of volume behind its recent upward move, no question about that. It's not like it's hitting new highs in light volume, which would be a warning sign. But still, Apple is very extended here. I think it's very risky. We're going to get a pullback at some point. I think. In fact, let me go back and take a look at the S&P 500 here, and then I'm going to pull up a weekly chart for the S&P 500. And all right, S&P. I never find the S&P 500 here. Bear with me here. Pulling this up in Tiger TV. All right. Well, can't find it. So let me go ahead and just pull up the S&P Large Cap Index, and then I'm going to go to a weekly chart. And I did this yesterday in my show. And basically, what you have with the S&P 500 is you can see an index that still looks like it's in the early stages of a breakout over its high earlier this year in May. Okay, so looking at the weekly chart, it really doesn't look like the train has left the station yet. Now, what could happen from here, and again, I'm making this judgment not only because of recent signs of institutional selling in the broad market, some recent higher volume declines, but the fact that there's just a number of extended stocks out there. Stocks need to take a breather at some point. So I would not be surprised, for example, to see the S&P 500 pay a visit to its 10-day moving average. And let me go ahead and just put the moving averages up here as well to give you an idea where the S&P 500 could pull back to from here. All right. There's the weekly for the S&P 500 with the 40-week moving average at 1260. The 10-week moving average, I should say, at 1347. That would be about 50 points, only about 3% from its current price level. Basically, at this point, I would not be surprised to see a 3 to 5% pullback here. I expect it's going to happen sooner rather than later. My Ultimate Growth Stocks model portfolio is positioned to take advantage if we do continue higher, but wouldn't be surprised to see a pullback. Coming up next, going to be joined by my good friend Bob Lang. Stick with us, folks.
Here's what people are saying about